There are moments in financial history when the ground shifts beneath our feet, and those who pay attention early enough reap the rewards of spotting the change. For years, cryptocurrency has been building quietly in the background, dismissed by many as a passing fad, a speculative bubble, or a playground for tech-savvy traders. Yet here we are in 2025, and it is no longer possible to deny that crypto's time has arrived. And at the heart of this transformation sits a project many once overlooked, Hedera Hashgraph, HBAR. The latest development fueling this momentum is nothing short of monumental. Grayscale, one of the largest digital asset managers in the world, has officially filed an S-1 form with the U.S. Securities and Exchange Commission, SEC, for a Hedera ETF. To appreciate the significance of this, you must understand both the weight of Grayscale's reputation and the role that exchange-traded funds, ETFs, play in unlocking institutional capital. For context, ETFs revolutionized traditional finance in the late 20th century by making broad market exposure simple, liquid, and accessible to both retail and institutional investors. Whether it's the S&P 500, gold, or bonds, ETFs transformed niche markets into mainstream investment vehicles. When Bitcoin ETFs launched, they didn't just validate crypto to Wall Street, they opened the floodgates for pension funds, insurance companies, and conservative asset managers to finally step into the arena. Now imagine that same tidal wave of capital flowing into a project like Hedera, one that already boasts partnerships with blue-chip corporations, regulated entities, and forward-thinking governments. The Grayscale HBAR Trust ETF filing is more than a technicality. It is a public declaration that Hedera is no longer on the fringes of the digital asset economy. It signals to the SEC, to Wall Street, and to investors worldwide that Hedera is ready for prime time. While approval may take months and regulatory hurdles still exist, the direction is clear. HBAR is stepping into the same category of legitimacy as Bitcoin and Ethereum. But here's why this matters even more for Hedera than it did for other crypto assets. Unlike projects that lean heavily on speculative narratives, Hedera has always been about utility and enterprise adoption. Its unique consensus mechanism, the Hashgraph algorithm, allows for speed, fairness, and efficiency at levels traditional blockchains still struggle to achieve. It is not trying to be another store of value coin. Instead, it is positioning itself as the infrastructure of tokenization, decentralized identity, payments, and enterprise-grade applications. This means that when ETFs open the gates of traditional capital, they won't just be fueling speculation. They'll be fueling real-world adoption. Consider this. The majority of investors still don't hold crypto directly. For a pension fund with trillions in assets under management, setting up a digital wallet, managing private keys, and navigating volatile exchanges is not just impractical. It's impossible under existing compliance frameworks. ETFs solve this problem neatly. They allow these massive pools of capital to gain exposure without having to change their operational structures. The moment a Hedera ETF becomes active, HBAR stops being a niche coin and becomes a recognized financial instrument. Let's pause here to reflect on the timing. Over the past 2 years, we've seen crypto go through a bruising bear market, regulatory crackdowns, and endless debates about whether digital assets even have a place in the modern economy. And yet, out of that fire, the strongest projects are emerging with more clarity than ever. Hedera didn't just survive that cycle. It quietly positioned itself at the forefront of regulated tokenization. From stablecoins to carbon credits, from enterprise supply chains to decentralized finance experiments, Hedera has been steadily building while others were distracted. So what does the Grayscale ETF actually unlock for HBAR investors? Legitimacy. SEC approval, even for a filing stage, is a signal to the world that Hedera belongs in the same conversation as the giants of crypto. Liquidity. ETFs allow institutional investors to deploy large sums of money quickly, without worrying about slippage or custodial headaches. That means deeper liquidity and more efficient markets for HBAR. Price discovery. With new money flowing in, we are likely to see more transparent and competitive pricing. Gone are the days when HBAR could be dismissed as an illiquid altcoin. Adoption feedback loop. As liquidity grows and institutions join the market, enterprises already building on Hedera gain confidence, which in turn attracts more users and developers. This is the classic flywheel effect that turns small ecosystems into global giants. Bitcoin experienced it with the arrival of institutional custody services. Ethereum saw it with DeFi and NFTs. Hedera is on the verge of experiencing it through tokenization and regulated capital markets. And make no mistake, the ETF is not just a financial product, it is a symbol. It tells investors that Hedera is not only technologically advanced but also institutionally credible. The days of being overlooked in favor of flashier projects may soon be over. But the ETF story is only half of the picture. What truly sets Hedera apart is that while Wall Street prepares to pour money in, the real-world infrastructure is already being built on its network. We're not talking about speculative meme coins or vaporware promises. We're talking about tokenization platforms like Arcax, which has just announced groundbreaking developments using Hedera to tokenize and bundle assets into innovative financial products. This synergy between Wall Street's capital inflow through ETFs and real-world utility through tokenization is what makes the Hedera story so compelling. You have the fuel, institutional money, and the engine, enterprise adoption. The combination is explosive. Hedera Hashgraph is standing at the crossroads of legitimacy and innovation. The Grayscale ETF filing is not a small headline to gloss over, it is a turning point. And unlike so many speculative projects that rise and fall on hype alone, Hedera's foundation is rooted in solving real problems for institutions, governments, and enterprises. With this kind of momentum, it's no longer a question of whether Hedera will break into the mainstream. The question now is, how quickly will it scale once the floodgates open? When we talk about the future of finance, it's tempting to imagine something abstract, far away, or theoretical. But in 2025, the future is already unfolding before our eyes, and few projects embody this transformation as clearly as Hedera Hashgraph, HBAR. The recent announcement from Arcax, a regulated UK-based digital asset exchange, custodian, and brokerage, marks a seismic shift, not just for Hedera, but for the entire financial industry. Arcax, already known for being the first FCA-regulated digital securities exchange in the United Kingdom, has launched pool tokens on Hedera, unlocking on-chain multi-asset portfolios. This may sound like industry jargon, but in reality, it is one of the most important milestones in financial history. To grasp its significance, let's break down what's happening and why Hedera is uniquely suited to lead this wave of tokenization. In the traditional financial system, investing in a diverse portfolio often means navigating layers of complexity. Prospectuses, custodians, intermediaries, paperwork, and settlement times that can stretch into days. If you want exposure to a basket of funds, say, BlackRock's money market funds combined with State Street and Legal & General, you're bound by legacy infrastructure that was never designed for instant programmable finance. Now, with Hedera's technology underpinning Arcax's platform, those same portfolios can be tokenized into pool tokens. A single digital token can represent ownership in multiple funds, offering instant creation. Portfolios can be minted as tokens in seconds. Composability. These tokens can be combined, transferred, or repurposed into new investment vehicles on the fly. Reduced friction. No more endless paperwork, transfer agents, or custodians bogging down settlement. Institutional-grade compliance, all while meeting the strict regulatory standards of the FCA and European markets. This is not just about digitizing existing financial instruments, it's about reimagining what's possible in financial engineering. With Hedera, an entirely new category of programmable, flexible, and instantly transferable financial products is being born. It's worth asking, why did Arcax choose Hedera? After all, dozens of blockchains claim they can handle tokenization. But the truth is that not all distributed ledger technologies are created equal. Hedera brings specific advantages that are tailor-made for institutions. Speed and efficiency. Hedera's Hashgraph consensus achieves finality in seconds, with throughput that outpaces most blockchains. For portfolios worth billions, speed isn't a luxury, it's a necessity. Fairness and security. Unlike proof-of-work or proof-of-stake systems that can be dominated by a few players, Hedera's consensus ensures fair ordering of transactions, critical in high-stakes financial environments. Low, predictable fees. While other networks fluctuate wildly depending on congestion, Hedera maintains rock-bottom, predictable transaction fees. For institutions planning long-term strategies, stability is priceless. Enterprise-grade governance. Hedera's governing council includes global giants, Google, IBM, Boeing, Deutsche Telekom, Standard Bank, and more, ensuring credibility and decentralized oversight. This is the kind of governance model institutions trust. Carbon-negative network. In an era where ESG compliance drives investment decisions, Hedera's environmentally sustainable design makes it a natural fit for institutions seeking to align finance with climate goals. These strengths are why Arcax didn't turn to Ethereum, Solana, or some newer blockchain experiment. They needed a platform that regulators would accept, enterprises would trust, and global investors could scale with. Hedera checked every box. So what exactly are pool tokens and why do they matter? Arcax's first pool token on Hedera represents a digital fund of funds. Specifically, it combines equal parts of money market funds managed by 4 of the world's most influential asset managers. BlackRock, the largest asset manager on the planet. State Street, a giant in custodial banking and asset servicing. Legal & General, the UK's largest financial institution. Aberdeen, a global investment powerhouse. This isn't just about digitizing one fund. It's about tokenizing the top-tier players of global finance and blending them into a single, instantly transferable digital instrument. Why does this matter? Because it collapses the old barriers of finance. In legacy systems, each of these funds is siloed with unique share classes, prospectuses, custodians, and regulatory paperwork. Bringing them together required cumbersome processes that slowed down innovation and limited investor flexibility. With Hedera, Arcax has demonstrated that you can now mint a token that represents all of them at once. That token can then be transferred, split, bundled, or even used as collateral in seconds. This is revolutionary. It's not simply about making existing processes faster, it's about enabling entirely new forms of financial engineering. Imagine structured products that combine low-risk treasury funds with high-yield crypto assets, or customized baskets tailored to investor preferences, all settled instantly and compliant by design. The news of Grayscale filing for an HBAR ETF is massive, but what Arcax and Hedera are doing may be even bigger. ETFs bring institutional capital into crypto by giving investors a familiar vehicle. Pool tokens, however, reshape the very foundation of financial markets. Here's why. Programmability. ETFs are still rigid by design. Pool tokens are flexible, composable, and programmable, allowing for constant innovation. Instant settlement. ETFs operate on legacy clearing systems that take days. Pool tokens settle in seconds. Reduced costs. By eliminating layers of intermediaries, pool tokens slash costs, making sophisticated products accessible to a broader range of investors. Global reach. Pool tokens aren't bound by the same geographic limitations as ETFs. They can be issued, traded, and settled globally on-chain. Collateral potential. Pool tokens can be instantly used as collateral in other transactions, unlocking liquidity and enabling new forms of decentralized finance at the institutional level. This isn't just an improvement. It's a paradigm shift. ETFs took traditional finance into the modern age. Pool tokens on Hedera may be what takes finance into the postmodern age of tokenized capital markets. The implications for Hedera are enormous. As the backbone for this new financial infrastructure, Hedera doesn't just gain visibility, it gains indispensability. Every time a pool token is created, transferred, or used as collateral, it strengthens Hedera's position as the go-to platform for tokenization. Think about it. When BlackRock, Legal & General, and State Street funds are minted onto Hedera's network, Hedera becomes embedded in the workflows of the world's largest financial institutions. This isn't just hype, it's adoption at the highest level. And adoption begets adoption. Once one category of assets is tokenized successfully, others will follow. Arcax has already signaled that pool tokens won't stop at money market funds. Future pool tokens could represent ETPs and indices. Entire equity indices could be minted into tokenized baskets. Commodities. Baskets of gold, oil, or agricultural products could be represented in pool tokens. Debt instruments, tokenized bonds and credit products could be combined into innovative new instruments. Crypto assets, tokens representing multiple cryptocurrencies could be bundled into compliant, regulated investment products. The scope is limitless, and Hedera is positioned at the very center. A first-mover advantage. Timing is everything. Hedera and Archax have achieved something first that many others only theorized about. By launching pool tokens in 2025, they've staked out a leadership position in the race to tokenize real-world assets. History shows us that being first to market matters. Think about Amazon in e-commerce, Google in search, or Apple in smartphones. Early movers who combine innovation with execution often dominate their industries for decades. Hedera's move into tokenized finance with Archax has the potential to put it on a similar trajectory. This is particularly true because financial infrastructure has high switching costs. Once institutions build on Hedera, they are unlikely to migrate to another network. The regulatory approvals, technological integrations, and compliance frameworks are too costly to replicate. That means Hedera's first-mover advantage could translate into long-term entrenchment. When you zoom out and look at the entire trajectory of Hedera, the picture starts to feel like it was building toward this very moment. For years, HBAR was the underdog. It wasn't the token grabbing the headlines in bull cycles. It didn't have a cult-like community screaming, "When Moon," every week. Instead, it was quietly aligning itself with institutions, working out the boring but essential infrastructure that global finance would need when it was finally ready to step into blockchain in a meaningful way. And now, in 2025, the pieces are snapping into place. The ETF narrative is one of those game changers. Even the mere whisper of Grayscale exploring an HBAR ETF was enough to wake up the market. Why? Because it signals something bigger: legitimacy. Institutions don't throw their weight behind projects they view as memes. They do it when they see a fundamental role in the future of financial markets. If Bitcoin ETFs were about introducing Wall Street to digital gold, then an HBAR ETF would be about introducing Wall Street to the infrastructure of tokenization, the rails for the future of money markets, private equity, and real-world assets. That's why Archax matters so much here. Think of Archax as the bridge. It's a regulated digital exchange based in London that is already moving traditional assets, like money market funds, onto Hedera through tokenization. That's not a white paper promise. That's live, functioning utility. And once those assets are tokenized, they need a settlement layer, they need a trusted network to secure and move value. Hedera was built for that exact job. It doesn't choke on high throughput, it doesn't stumble on governance, and it doesn't rely on hopium to scale. This is where the conversation shifts from speculation to inevitability. If money market funds, one of the most conservative and liquid financial instruments in the world, are being tokenized on Hedera, what does that say about where this trend is heading? If Archax is rolling out pools of tokenized real-world assets, what does that imply for the long-term demand for HBAR as the gas of this ecosystem? The writing is already on the wall. Now let's talk price action, because that's what everyone's secretly itching to know. History has taught us that real-world adoption often lags behind speculation. In 2021, plenty of projects with no users or products reached insane valuations. Hedera, with its enterprise-grade tech, sat in the shadows. But as cycles mature, the market begins to reward the players with substance. That's where HBAR's multi-dollar thesis comes in. Analysts who've mapped out Hedera's growth trajectory suggest that $2 to $5 isn't just hopium. It's within reach if tokenization grows the way it's currently projected. That's a massive leap from today's price range, and it doesn't even require Hedera to capture the entire tokenization market. Even a slice of it would be enough to ignite demand for HBAR. Compare that to the projects riding purely on hype, and you start to see the difference. Meme coins may offer quick dopamine hits, but when the dust settles, capital flows into infrastructure. Hedera isn't promising to reinvent finance on a dream. It's already doing it, one partnership at a time, one real-world asset at a time. And the ETF speculation just adds fuel to the fire. If such a product were approved, it wouldn't just bring liquidity. It would validate Hedera's role as a serious player in the global financial system. Looking out to 2030, You can almost see the two worlds converging. The old world of finance, with its strict compliance and massive liquidity, and the new world of blockchain, with its speed, efficiency, and openness. Hedera is standing right at that intersection. The governing council isn't just a flashy name drop. It's Google, IBM, Boeing, Standard Bank, and other heavyweights who are literally shaping the network's direction. No other blockchain can claim that mix of decentralization, corporate oversight, and scalability. So where does that leave you, the investor, the builder, the observer? It leaves you with a rare opportunity. We're not talking about chasing the latest meme run or flipping NFTs for a quick buck. We're talking about positioning yourself in a project that is quietly embedding itself into the financial bloodstream of the world. When people look back in 2030, they may say, of course Hedera won, it had the governance, the tech, the partnerships, the regulation-friendly design. But the ones who'll be smiling the most are the people who saw it early and acted on it. And that's the real call to action here. Don't wait for an ETF approval headline to validate what's already happening. Don't wait for ARCAX to tokenize trillions before you notice the shift. Hedera is not just another altcoin. It's infrastructure. It's the kind of project that can survive bear markets, regulatory shakeups, and the collapse of weaker competitors because it's playing a long game. The question is whether you're willing to play that game too. If you're building, start exploring what tokenization on Hedera can offer. If you're investing, think about what a position today could mean 5 years down the road. If you're watching from the sidelines, ask yourself how many more cycles you're going to watch before you decide to take part. This isn't financial advice. It's common sense. The train is already moving, and Hedera has secured its seat at the front of it. As we close this discussion, remember this: markets move in cycles, but infrastructure endures. HBAR isn't promising you a flashy story. It's delivering a backbone for the financial future. Whether it's through ETFs, tokenized funds, or the daily transactions we barely notice, Hedera will be there, quietly powering it all. The smart move is to not just watch history unfold, but to claim your stake in it while the window is still wide open.